Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing a significant development from the Bank of Canada. The central bank has announced plans to end quantitative tightening earlier than initially expected and to return to more normal asset purchasing levels. This move positions the Bank of Canada as potentially the first major central bank to unwind its pandemic asset purchases. Deputy Governor Tony Gravel shared these insights during a recent speech in Toronto. Gravel explained that quantitative tightening, or QT, has achieved its intended goals. We expect to announce the end of QT and the associated restart of our business-as-usual asset purchases in the first half of this year, Gravel stated. He highlighted that the Bank of Canada aims to be among the first to complete the unwinding of its pandemic-related quantitative easing asset purchases. For those unfamiliar with the term, quantitative tightening refers to the process where a central bank reduces its balance sheet by allowing bonds it holds to mature without purchasing new ones. This approach effectively pulls some of the liquidity that was injected into the economy back out. It's essentially the opposite of quantitative easing, which floods the market with money to lower borrowing costs and stimulate economic growth. In Canada, quantitative easing began in March 2020 at the height of the pandemic. The Bank of Canada purchased government bonds on a large scale to stabilize financial markets and keep borrowing costs low for both consumers and businesses. By 2021, the bank's balance sheet had grown to approximately $395 billion. However, as the economy began to recover, the Bank of Canada shifted to quantitative tightening in April 2022, halting new bond purchases and allowing existing ones to mature. Since then, the balance sheet has shrunk to $130 billion as part of efforts to cool inflation that reached multi-decade highs in 2022. So, why end quantitative tightening now? Gravel indicated that the process has successfully tightened financial conditions, complementing the Bank of Canada's interest rate hikes, which have helped bring inflation under control. Initially, the bank anticipated ending QT when settlement balances reached between $20 billion and $60 billion. However, an updated assessment now targets a range of $50 billion to $70 billion. It is projected that settlement balances will fall below this range by the third quarter of 2025, driven by the maturity of a significant Government of Canada bond on September 1st. To manage this transition smoothly, the Bank of Canada plans to restart its normal asset purchases gradually, well ahead of September. This approach aims to offset the sharp and sudden drop in settlement balances as they approach the large bond maturity date. Scotiabank economist Derek Holt commented on Gravel's remarks, noting that they put a bit more meat on the bone regarding the Bank of Canada's long-term plans for managing its balance sheet and its role in the bond market and payment system. Holt suggested that the bank might be seeking to provide more certainty about its framework amidst a period of heightened macroeconomic uncertainty. Interest rates are on the way down, and hopes are high that the mortgage market is headed for a busy year in 2025. However, there are still plenty of challenges ahead, not least affordability struggles and a supply shortage. How are brokers shaping up for the year ahead, and what should they be keeping top of mind about the market for the next 12 months? We caught up with Hugo Dos Reis of Vine Group to hear his thoughts about what's in store for 2025 and his top advice for brokers to grow their business in the current market. Hugo Dos Reis, who is a seasoned expert in the field, shared his optimism about the upcoming year, noting that the downward trend in interest rates could potentially invigorate the market. He emphasized, however, that brokers should not become complacent. It's crucial for brokers to stay agile and informed, Dos Reis stated. While lower interest rates can drive demand, the persistent issues of affordability and supply constraints will continue to pose significant challenges. Affordability remains a key concern, especially in major urban centers where housing prices have consistently outpaced income growth. Dos Reis pointed out that brokers need to be creative in finding solutions that can help potential homeowners navigate these hurdles. It's about understanding each client's unique financial situation and being able to offer tailored solutions, he explained. Sometimes this means looking at alternative lending options or government programs that can provide additional support. Supply shortages are another critical issue that brokers will need to contend with. The demand for housing continues to outstrip supply in many areas, a trend that has been exacerbated by pandemic-related disruptions in the construction industry. Dos Reis highlighted that staying informed about new developments and understanding zoning changes or municipal plans can give brokers a competitive edge. Being proactive in understanding where new housing developments are planned can help brokers guide their clients towards opportunities, he said. Looking ahead, Dos Reis advised brokers to focus on building robust relationships with clients and industry partners. Networking and maintaining strong connections within the industry will be key to navigating the challenges of 2025, he remarked. By collaborating with other professionals, brokers can better serve their clients and find innovative solutions to complex problems. Ultimately, while the prospect of a busier mortgage market in 2025 is promising, brokers will need to be strategic and adaptable to capitalize on these opportunities. Dos Reis concluded with a reminder that the market is always evolving, and staying ahead requires continuous learning and flexibility. The brokers who thrive will be those who are willing to adapt and grow with the market, he said. In recent news, Westboro Mortgage Investment Corporation, commonly known as MIC, has announced the resignation of its chief executive officer, Nick Christopoulos. His resignation became effective on December 31, 2024. Nick Christopoulos has been an integral part of the company for the past 4 years, where he played a pivotal role in spearheading the organic growth strategy of the fund. During his tenure as chief executive officer, Christopoulos significantly contributed to the steady increase of the fund's annual compounded return on investment for F-class investors, which rose from 6.4% 4 years ago to an impressive 10.69% last month. Furthermore, under his leadership, the fund's assets under management grew from $230 million to $496 million. Investor equity also saw substantial growth, increasing from $177 million to $361 million. Additionally, the syndicated line of credit, led by TD Bank, expanded from $90 million to $260 million. Nick Christopoulos expressed his gratitude for the opportunity to lead Westboro MIC during a period marked by significant challenges, including the pandemic and subsequent rapid interest rate hikes that posed economic difficulties for borrowers. I am proud of what we have accomplished together as a cohesive team during these challenging times, Christopoulos stated. He also mentioned that he is looking forward to continuing his association with the fund as a board director, where he intends to guide and support its future success. The board of directors at Westboro MIC has expressed appreciation for Christopoulos' strong leadership and contributions, and they have conveyed their best wishes for his future endeavors. Interestingly, the board has announced that there are no immediate plans to fill the chief executive officer position, indicating a possible strategic shift or restructuring within the company. Westboro Mortgage Investment Corporation remains committed to its core objective of providing a consistent fixed income solution that delivers above-average risk-adjusted returns for its investors. The company continues to focus on personalized service and tailored financing solutions to help customers in Ontario achieve their homeownership goals. In our final segment today, we're turning our attention to a report that sheds light on the potential impact of tariffs imposed by the United States on the Metro Vancouver real estate market. The report, released by the Greater Vancouver Realtors, suggests that these tariffs could have a short-lived effect on the region's housing market. The Greater Vancouver Realtors, representing 15,000 realtors, have conducted a preliminary investigation and economic modeling to assess the situation. They predict that while there may be an initial drag on sales due to a slowdown in cross-border investments, the effect is likely to be temporary. The association's annual residential market sales forecast indicates that any decline in sales activity is expected to be short-term. The report also highlights the potential broader economic factors at play. If a recession were to occur, accompanied by significant job losses, the pool of buyers could shrink, leading to a decline in sales for 2025. However, the forecast remains optimistic, predicting a 13.9% increase in total sales this year, largely driven by lower borrowing costs that are expected to stimulate the market in the first half of the year. In terms of home prices, the report anticipates an average increase of 4.1%, bringing the average home price to $1.3 million across the 15 jurisdictions it covers, from Whistler to South Delta. The authors of the report note that the market is benefiting from significantly lower borrowing costs at the start of the year, which should help achieve the price predictions for 2025. Interestingly, the report points out that political dynamics could also play a role in shaping the market. With Donald Trump as the president-elect, there's a threat of a 25% tariff on Canadian goods. Additionally, potential changes in the Canadian federal government could introduce new policies that might either positively or negatively impact the housing market. The Greater Vancouver Realtors forecast for 2024 had initially predicted an 8% increase in overall sales, but actual sales ended up being less than 2% higher than the previous year. This illustrates how unpredictable the market can be, with unforeseen factors often creating plot twists in annual forecasts. Overall, while there are potential challenges on the horizon, the report maintains a cautiously optimistic outlook for the Metro Vancouver real estate market in 2025. The anticipated lower borrowing costs and the expectation of a rebound in sales activity are seen as key drivers for the market's performance this year. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.